Good morning, everybody. Thank you for joining us. My name is Sarah Hastings-Simon, and I'm one of the co-directors of the Net Zero Electricity Research Initiative, or NZERI. And so it's my pleasure today to welcome you to this edition of the Electricity Learning Series, where we'll hear in just a moment from Dr. Emily Grubert about some interesting work that she's done looking at the impacts of CCS and the role of CCS in decarbonization in the US. Which obviously has some really interesting learnings for us up here in Canada as well. Before we start, I'd just like to acknowledge that I am speaking to you from Calgary, and the University of Calgary, which is located in the heart of southern Alberta, both acknowledges and pays tribute to the traditional territories of the people of Treaty 7, which include the Blackfoot Confederacy, comprised of the Siksika, the Piikani, and the Kainai First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Goodstoney First Nations. And the city of Calgary, where I'm based, is also home to the Métis Nation of Alberta, Districts 5 and 6. So, as I said, this is one in our series of the Electricity Learning Series from NZERI. If you would like to get more information and you didn't come across this event from the NZERI website itself, you can check that out at nzeri.ca and find out, register to get notified about future events and see more of the work that's going on there underneath the research initiative that's supported by Alberta Innovates. But for today, I'd like to welcome our speaker, Dr. Emily Grubert, who is an associate professor at Notre Dame, where she is working on topics on questions of energy transition. Dr. Grubert is going to share with us today some of her recent work on carbon capture and storage. Please put your questions for her in the Q&A. You can also, I think, see questions that are already in there, but we'll have some time at the end of the talk today to ask questions. So without further ado, I'll hand it over to Dr. Grubert.
Thanks so much, Sarah, and thanks to the University of Calgary and NZERI, and thanks to everybody for joining today. So I'm going to talk a little bit, as Sarah said, about some recent work that I've been doing on basically some of the incentives that exist in the United States under some of the policies that we have set up for carbon capture and storage, and particularly in the fossil sector. So I want to be really explicit about a couple of boundaries of this work. This is very explicitly looking not just at the United States exclusively, but also at fossil-fired electricity specifically in thinking about CCS. There's some things here that are probably translatable, but there's some very specific ways that power sectors work that are pretty different from the way that other industrial sectors work. So like cement, other things like that, where we might also see some CCS development. And so I just want to be clear that this is really about electricity, but I'm going to talk a little bit about how the Inflation Reduction Act, which is a recently passed law that's very reliant on subsidy mechanisms for enacting policy, creates certain incentives under for fossil power CCS that are not necessarily consistent with emissions mitigation. So I look forward to your questions also, but that's kind of where we're going to go today. So just to kick it right off and be really explicit, the kind of core point that I want to make and want to kind of show you throughout the next 40 minutes or so is that the tax credit that we have for carbon capture and storage in the United States, which is Section 45Q, administered by our Internal Revenue Service under the Department of Treasury, does not actually incentivize carbon dioxide abatement or cost minimization in the power sector. There are some really interesting implications of this, and notably this point that because you're not actually incentivizing either CO2 abatement or cost minimization means that a really serious success with deploying this tax credit doesn't necessarily align with some of the goals that we have. I'll get a little bit into the history of this tax credit in a minute, but I think this overall point that it's not actually incentivizing abatement or cost minimization is a really important one for how we think about how this might actually impact changes in the power sector going forward. So this work today that I'm going to be talking about is based on a paper that came out earlier this year that I wrote with Francis Sawyer, basically looking at some of the incentives that we see around US power sector carbon capture and storage under the Inflation Reduction Act, And in that context, we basically take a generator level model to look at what would happen under profit maximization rather than a more typical cost minimization or others like emissions optimization kind of a model. So in that profit maximizing setting, what we find is that retrofits of fossil-fired power in the United States to add carbon capture and storage could actually end up demanding between 0.4 and $3.6 trillion in tax credits in order to either, at the low end, this $0.4 trillion, reduce greenhouse gas emissions by about 24% in that sector, or at the high end, where you see this $3.6 trillion in tax credits being put through the system, actually increasing emissions by about 80% relative to business as usual. And I'll talk a little bit about why this is, but this, I think, fundamental point that it's not completely monotonic, but in general, the more tax credits you end up paying out, the more risk you have of increased rather than decreased emissions. And so this becomes a very, very costly policy with limited benefit from a climate perspective is a pretty important one. But again, kind of the core point that a lot of this analysis is based on is looking at what tax credits would do in a profit maximizing setting as opposed to a cost minimizing or emissions optimization setting. We think that this is a bit more accurate in terms of thinking about what behaviors look like, but I'll talk a little bit about some of the assumptions that we made over the next few slides. So to take a step back also, I know some folks are probably familiar with both the Inflation Reduction Act or IRA and 45Q, which is a tax credit that's been around for a while. But essentially, the 45Q tax credit has been in place since 2008, and this is basically a tax credit that is focused on expanding the carbon oxide sequestration industry. So we talk about this as a carbon oxide sequestration credit because you're using it either for carbon dioxide, which is most of what we expect or see, but also carbon monoxide sequestration is eligible for this tax credit. So it's mostly CO2, but there is some eligibility for carbon monoxide as well, mostly in utilization pathways. But 45Q was essentially introduced as a way to try to encourage the development of a CO2 sequestration sector. It has a couple of different pathways, one being that you can put CO2 into products, and another being that you can put it underground. Within the underground setting, you can either devote it to situations where you're using the CO2 for enhanced oil recovery or EOR, or you can use it as a dedicated geologic storage situation where it's not actually being used for additional oil production. So there's a few branches of this, but essentially in 2008, this was developed largely to encourage people to start to learn how to do this. I think that's a really important point of history for this tax credit, because as I said a minute ago, or as I asserted a minute ago, it's not really designed for emissions abatement. It's not really designed to reduce costs in the power sector. What it is designed for is to get people to start to try to store CO2. And that history of it as being more of an industrial development nudge as opposed to a climate policy remains extremely important, particularly now as we're trying to use it more as a climate policy. So the big reason why this is interesting in the Inflation Reduction Act context, given that this tax credit has actually been around for about 15 years already, is that it was changed in three pretty important ways under IRA, which was passed last year. So the first one being that the credit has increased. So like I said a minute ago, there are a couple of different pathways that you can use to acquire this tax credit, but focusing only on the situation where you're using CO2 or you're storing CO2 in a dedicated storage situation as opposed to utilizing it or using it for EOR, the credit increased from $50 a ton to $85 a ton. Part of the reason that I put a tilde here is because that $85 also assumes that you meet a certain set of labor requirements and a couple of other like infrastructure sourcing kinds of things, but effectively in practice, we expect most people that would be claiming the credit to be eligible for the $85 for dedicated storage. It's a little lower if you are using it for EOR, and it's a little higher if you're using direct air capture, but in the power plant context, assuming dedicated storage, we saw an increase from $50 to $85 a ton. I will say this is something that has gotten quite a lot of immediate attention as, you know, we've increased this credit so much. People hadn't really been using 45Q that much previously, and we hadn't seen a lot of activity in terms of CO2 storage. The expectation is increasing this credit by a lot was going to maybe prompt more economic viability in certain sectors. The way that that gets a little complex is that these are not inflation pegged. So in practice, that $50 to $85 increase is not as big of an increase as it seems. $50 in 2008 is, I think, on the order of maybe $70, $75 in 2022, $2023. So it is an increase, but it's not kind of the dramatic increase that we sometimes view it as, because these are not in the same base year dollars, essentially. So some of it is catching up with inflation, some of it is actually an increase. One of the other really big important ways that 45Q was changed under IRA is that the threshold for facilities that are allowed to use it was dropped really dramatically. So it used to be the case that you could only claim 45Q if you were a facility that was emitting at least 500,000 tons of CO2 per year. Now that threshold is 18,750. There are some kind of goofy backstory reasons to why that's the number, but effectively this makes a huge number of power plants eligible that were not previously eligible. I would argue that this is actually more relevant outside of the power sector, but again, today, really just talking about the power sector. But this means that it's not really just the giant coal-fired power plants that are eligible anymore. There are many smaller plants and many natural gas plants that are now eligible as well. The third thing that's really important, and particularly in the context of some expectations for other climate policy within the United States, is that there is a much longer time frame for eligibility given this update under IRA. So up until IRA was passed, the 45Q tax credit was only claimable if you had commenced construction on your CCS project, so broken ground essentially, by 2026. Now, that timeframe has been extended to 2032, which is not that long, it's 6 years, but in thinking about where we expect a lot of projects to be going, potentially bumping that up that additional 6 years is actually pretty meaningful in terms of kind of announced projects and intent to decarbonize that we see coming out of the power sector. So not saying that this is necessarily going to lead to a whole lot more, but the eligibility has changed really dramatically, both because of the longer time frame and the lower threshold, in addition to the fact that the credit is actually larger, particularly because we've been seeing this inflationary effect, basically reducing the value of that credit for quite a while. So hypothetically, when we look at 45Q under IRA, there is an expectation that quite a bit more carbon capture and storage activity is likely to be encouraged by this subsidy than was before, even though the tax credit's been in place for quite a while. The thing that is the same as it has always been, or as it has been for the last 15 years, is that 45Q is a production tax credit for CO2 effectively. So you get paid for an individual ton of CO2 that's stored in one of the eligible manners, including dedicated geologic storage. Again, it doesn't use a life cycle metric for like total abatement or something like that. It is credited based on the number of tons that you're able to store. So effectively, it's a CO2 production tax credit, assuming that you manage that CO2 in a particular way. And the other thing that's kind of important about this is that it's claimable for 12 years. CCS is not required in the United States. In most of these contexts, there are not actually requirements for emissions reduction in general. And so basically what we end up seeing is that this is an expensive thing to do. So CCS is not going to reduce your costs ever. It's always going to increase them. And so you generally expect to need some sort of subsidy or somebody requiring you to do it if it's going to continue. The reason that I bring this up in the 12 years context, as you'll see in a few minutes, is actually pretty important, basically because having a tax credit that is available for the first 12 years of a project's operating lifespan makes a lot of sense if you're basically using that tax credit to subsidize capital or something like that. In this case, you're largely subsidizing pretty high operational costs. And so once the money goes away after 12 years, there are a lot of questions about how you continue to run that CCS unit. If you're not required to do it and if nobody is paying you to do so. So it's a short-term thing. It's much shorter than the lifespan that we would expect from a typical CCS unit. And it encourages more CO2 production versus less CO2 production. And those 2 points actually become pretty important when we look at this in kind of a expected behavior context. One of the other things about 45Q under IRA is that it does not have abatement guardrails. So what I mean by that is basically IRA does not actually require you to demonstrate that you are reducing emissions in order to claim this credit. The credit is absolutely designed around essentially trying to maximize storage of CO2. There's not a measure that says, are you actually reducing the CO2 that was emitted in the first place or overall? There's no life cycle assessment requirement, any of those types of things. There are other tax credits within IRA that do have such abatement guardrails. So in particular, the hydrogen one, if people are familiar with US tax policy, does require some evaluation of life cycle emissions. This one does not. And that's a really important distinction, I think. All right, another point just to kind of get everybody on the same page that I'm going to be talking from at least is that the US fossil power sector has some particular characteristics that are important for the way that we expect 45Q to be taken up. So one is that fossil electricity generating units, or EGUs, are disproportionately owned by utilities relative to other kinds of power plants. Basically, in the US, about 60% of US fossil plants are owned by utilities, whereas only about 14% of US modern renewables, so solar, wind, and geothermal, are owned by utilities. Utilities are able to go back to their ratepayers and essentially collect capital expenditures from those ratepayers. And so generally speaking, a utility's behavior is very much motivated by capital investments. The reason that this is important in the context of utilities disproportionately owning fossil fuel generating units is that if you are looking for a way to recover spend, you are probably going to be looking for opportunities to invest capital into your existing facilities or to build new facilities. If you've got a huge amount of existing infrastructure on the fossil side, CCS is actually pretty attractive because it's a very expensive capital expenditure, in addition to being operationally expensive, that you are then able to pass on to your ratepayers. So it's not that it's free exactly, but from a utility perspective, capital investments are not really expensive. CCS is also something that is itself pretty expensive. So we would generally expect for a kind of biggish power plant for a CCS retrofit to cost about $1 billion, maybe more, depending on how big the plant is. And so in the context of utilities being able to invest that sort of $1 billion scale amount into facilities that they already own, which also gives them an opportunity to update that plant probably, and actually achieve their kind of regulated rate of return or their profit margin on that capital expenditure, there's a big incentive for them to find opportunities to put capital into their existing units. They also don't necessarily have a lot of expertise in operating renewables. And so the reason why this becomes pretty important in terms of thinking about kind of individual behavior is that a utility is probably less likely to just look at a spreadsheet and say, you know, renewables are cheaper than CCS, so we're going to close down the plant that we know how to operate, that we already own, et cetera, and build a whole bunch of stuff that we're not that familiar with, when they have an opportunity to put something that is basically free and actually gives them a profit margin onto the utility assets that they already own and operate and understand. The other thing, and this is kind of an obvious point, but becomes important analytically in a minute, is that fossil electricity generating units emit a lot of CO2 when they generate additional power. And since 45Q is effectively set up as a production tax credit for CO2 that you then store, there's an incentive to emit more CO2 if you can. And just to kind of put a point on this, 45Q as a tax credit, when you kind of spin out the tons of CO2 per kilowatt hour, things like that, is worth about 9 cents per kilowatt hour for coal and about 3 cents per kilowatt hour for natural gas. So big incentive to put this on coal. This is not to say that there aren't costs to running CCS. Like obviously there are things that you're having to pay for with that subsidy, but just as a little bit of a frame, CCS is easier on coal than it is for gas because the CO2 concentrations are higher and therefore easier to separate, and the subsidy is much more significant for those coal units. Compare that to the production tax credit for zero carbon resources under IRA, which is 2.6 cents per kilowatt hour, and you kind of start to see that even though there are obviously costs associated with installing CCS, there's kind of this agnosticism around capital investments by utilities, and then a pretty significant operational subsidy under 45Q to run CCS while you have opportunity to actually claim that tax credit. And then the last point here is that fossil EGUs in the US are old, which is important also because this kind of gives an opportunity not only for utilities to invest in plants that they can then update a little bit, maybe keep operating for longer, but also that any lifespan extension that you see associated with CCS is probably keeping a plant online that would have otherwise closed. So if I invest $1 billion in a plant that was 2 years away from retirement and therefore keep it operating for another 30 years, relative to the counterfactual, I have a lot more emissions that are potentially happening, especially if I'm not capturing them all. So to kind of put a finer point on that, this is a map of fossil-fired EGUs in the United States. The red dots are gas plants and the black dots are coal plants. There's a few green dots as well that are operating mostly on oil-derived fuels, which is pretty unusual, but there are a few. But basically, this is the fossil power sector as of 2018. When we apply lifespan-based analysis to this, what we effectively see is that by about 2035, the large majority of plants have already reached end of life. The reason that this is important is when you start to think again about investments that might keep plants operating longer, it's not really the case that we have a whole bunch of plants that are definitely going to be operating into mid-century. So better to put CCS on them than to allow them to operate unabated for the next 30 years. Many of these plants are either already past what a typical lifespan would be or are coming up on that end of life relatively quickly. So in general, this is not universally true, but in general, if you're installing a CCS unit by 2032, which is the 45Q kind of deadline for commencing construction, and then you assume that it takes 3 or 4 years to get that unit up and running, which is basically what most federal models assume, you've basically got CCS up and running by 2035. That's the point at which the new lifespan of the plant starts. And what you can kind of see from this as it gets back to 2035 is that there aren't a lot of plants that would necessarily still be expected to be running by then. So you're probably doing a lifespan extension, and that probably means that any emissions you have coming off of that plant are additional to what you would have found otherwise. So that's a whole lot of background to kind of lead into the model that we built and kind of talking about what this means for 45Q and for CCS in the US in general. And what we essentially ask is what happens given all of these factors with power sector 45Q incentives on coal and gas plants for the most part, assuming that you're trying to maximize profit at a unit level instead of trying to minimize costs at the system level. And the reason that we wanted to ask this question this way is because a lot of models of how IRA might affect the US power sector were assuming system level cost minimization. And we basically looked at this and thought about different ownership structures, different incentive structures. Again, this issue about utilities being able to rate-based capital and also owning much more fossil relative to renewables seemed to be relevant in terms of behavior. We wanted to see what we might expect to happen when you look at it kind of at the individual unit decision level, as opposed to what kind of an ideal case outcome could be. So in doing that, we investigate a couple of big dynamics and then make some assumptions. And I've introduced a couple, or I've teased a few of these already, but just to kind of step through them so that we can then talk about the model outputs. The dynamics that are most important and are most integrated into the model that we put together is essentially this notion that a big investment in capital intensive equipment is going to tend to lead to extending the lifetime of a plant. So essentially kicking that retirement date out further. We've seen this pretty consistently with flue gas desulfurizers. So when a plant installs sort of a $100 million pollution control facility, you tend to see them expecting that that plant is going to last longer, essentially because there is a time period over which you do capital recovery. Even though you are able to do that capital recovery, it takes a little while. So we've seen this also in just announcements that utilities and plants have made about what they expect to happen to the facility if they install CCS. Most notably, actually, Boundary Dam in Canada does explicitly state in some of its initial documents when they were installing a CCS unit there that they expected that CCS unit to extend the plant's lifetime by a few decades. So this is a fairly explicit thing that is happening, and also one that kind of makes sense in the context of how rate recovery works and how capital recovery works. The other big dynamic that we look at and the variable that it affects is basically that an incentive like 45Q that is going to tend to increase if you produce more. So the more CO2 you make, the more CO2 you can store, and the more subsidy that you can claim is going to tend to lead to more production. And this is essentially an increase in capacity factor intended to really maximize the amount of credit that you're able to claim. This is one of these places also where the dynamic around CCS, where it's both capital intensive and operationally intensive, becomes important. So you have a situation where you're putting in a bunch of capital, and the only way that you start to recover that outside of a rate recovery setting is to claim the subsidy on the output. So you're going to want to have maximum output for that big capital investment in general. Some of the big assumptions that we make in this model, and this is simplified, obviously, we're really trying to kind of put some boundaries on what might happen when you look at it from this way. But a few of the assumptions that we make are things like fossil EGU owners are going to tend to prefer to invest in keeping their existing equipment profitable. So if they have the opportunity to keep equipment that they already have and they already understand, they already have an appropriate workforce for, if that can stay profitable, they will probably prefer to do that than completely switch technologies. So if you've got a utility that is very, very good at operating coal-fired power plants, if the coal-fired power plant is profitable, they're probably not going to shut it all down and move over to solar, even if the solar is marginally more profitable, potentially. Another core assumption is that utilities will probably prefer to delay construction in order to take advantage of learning and because of the time value of money. So you're going to tend to see people breaking ground on CCS units as late as possible, as opposed to as early as possible. So in that context of 45Q being claimable, as long as you've broken ground by 2032, we tend to look at options where plants are basically delaying construction up until either 2032 or far enough in advance of when they would have retired to still be able to claim the credit. But if you could start now, or you could wait 10 years, we're assuming that you would rather wait 10 years if you can. The other assumption we make, and this is actually something that since the paper came out, we've seen a few proponents actually say explicitly, so we feel relatively good about this one, at least in some contexts, is that an EGU will stop operating the CO2 capture unit if it's not profitable. So a CCS unit is integrated into a power plant, but it's not fundamental to operations. You actually can turn it off. And so our assumption is that if you have a situation where it's kind of long-term, not profitable, not sort of hour by hour, because we did look at that a little bit and that doesn't seem to be that big of a problem. But if it's sort of long-term unprofitable, such as if the tax credit goes away, probably the EGUs will turn off the capture unit and keep operating the underlying power plant. And then the last one, this is kind of more model-based kinds of things, but we assume that cost match assumptions within the US's long-term projection of how electricity systems evolve, so the annual energy outlook. But we assume that costs of retrofits are the difference between new build plants that either do or do not have CCS. So this is probably an underestimate of capital costs because retrofits tend to be more expensive than new build. We also assume that all retrofits succeed. So CCS works in this model. Anytime you try to build it, you're totally successful. And we assume all storage is free. That's probably the biggest distortionary assumption that we make. But in general, storage and transportation costs are kind of on the order of $10 or $15 a ton, with some expectations that those might get lower. So as a first pass, this is probably reasonable, but the model is also capable of having some of these assumptions tweaked. So if you get really interested in this and want to play along with the model and you want to include storage, basically just bump up or bump down the tax credit to account for additional costs and can rerun the model that way. But this is essentially the very big inputs that we put into the model as we developed it. So with that, basically what this looks like is an Excel model. It's open access on the internet if anyone would like to look at it, that is ownership conscious. So basically we look at each individual generator in the United States based on who owns it, mostly utilities. We do account for the fact that some units are actually owned by multiple utilities at once. At the generator level, and then basically say, what would CCS retrofit look like if you were trying to make decisions at the individual generator level to maximize profitability, essentially. And a couple of the variables that we allow to move are essentially the ones that I was just talking about. So mostly retirement deadline or retirement date, and then also capacity factor. So as you can kind of see in this user inputs tab, we basically model by asking whether CCS is allowed in the first place. This allows us to kind of evaluate a counterfactual for some of our baseline assumptions. And then we say, if you add CCS, do you extend the lifespan of your plant by some amount of years? And if you add CCS, do you change the capacity factor of your plant? Basically setting a new minimum. And then we also have a way to model if you had a policy that basically says you have to close all your coal by some date, you have to close all your gas by some date, et cetera. So this is a lot of detail, but I just wanted to flash it up so that people kind of have a sense of what we looked at here. But basically, we put together 6 CCS scenarios that essentially say you have some amount of lifespan extension. So the first number in all of these little parentheticals in the descriptor column are basically how many years longer you would expect the plant to operate. This is the lifespan extension from CCS retrofit as well. So we look at no extension, a 12-year extension, basically to ensure that any plant that's retrofitting can take advantage of the full 12 years of the credit, and then a 20-year lifespan extension, which is probably conservatively low based on what we've seen utilities and other project proponents talking about. You often see people saying maybe a 30-year extension is expected. But we basically look at these 3 as a starting point, and you can put in other ones if you want to. And then on the capacity factor, we did some calculations to basically say where you start to see quick paybacks and at what capacity factors you would expect to see the ability to really recover all of your capital, even just from the tax credit and things like that. And so we essentially look at scenarios where the minimum capacity factor for a coal plant with CCS jumps up to 90%, which is consistent with how some plants run. Not all of them run that high, but many do. And then on the gas side, we assume that they go up to 70% capacity factor. So the higher of either these values or what it already was. Then in a second set of scenarios, we also kind of look at this lifespan extension, but assume that the capacity factor doesn't change. So again, 2 big variables are you just put a bunch of money into your plant, so it's going to last longer, and you're encouraged to make as much CO2 as you can, so you're going to run it harder, basically. And then we also look at a couple of counterfactuals of basically what we think business as usual would look like with an awareness of how old plants tend to be. So this assumes that they kind of retire at the end of a typical lifespan for the same type of technology and the same type of fuel. And then we look at another scenario that says, close all fossil units by 2035. This is based on an executive order in the United States that essentially sets a target of carbon pollution-free power by 2035. And then another one that just says, let gas and the oil plants do whatever they want, but coal plants must close down by 2030. That's not a formally proposed deadline, but it's something that many people have talked about in the context of kind of rapid ability to ramp down emissions in the US fossil sector. This is a bunch of variables, and mostly just putting this up so that people have a little bit of a sense. But the couple things I want to call your attention to are mostly that the fuel increases are based on differences between what the annual energy outlook suggests is true for new build plants with CCS versus new build plants without CCS, and the capital expenditures as well are based on that difference between new builds with and without CCS. So again, probably actually underestimating the energy intensity and the capital expenditure that we would expect for retrofits, but it's approximately kind of the best that we have. We haven't seen a lot of retrofits yet, so there's not a ton of empirical data. I will say also, since this paper has come out, there have been a couple more projects that have advanced further. They're not operating yet, but our estimates for costs for some of those retrofits are actually very similar to what the project proponents are saying. So we feel relatively good that these are at least reasonable guesses. Okay, cool. So where that goes, basically 45Q incentivizes very high capacity factor CCS for 12 years. And because of the size of the subsidy and because of the ability for most of these plants to claim rate recovery, you would expect most coal and many gas EGUs to install CCS in kind of a totally profit maximizing scenario. There are a lot of other reasons why you might not see people actually installing CCS. So whether it works super well, supply chain access, ability to actually install it, space restrictions on site, et cetera. But again, this kind of assumes that any plant that would be observing profits by having CCS and wants to install it because of that profitability is able to, and that the retrofit succeeds. But what this basically shows is that in a scenario where you assume the subsidy goes away after 12 years, you would expect the plants to turn off the CCS at the end of that. So you run pretty hard for a while and then go back to your original capacity factor, but turn off the CCS. The implication of that is that you have many, many more emissions than you would have otherwise because you have all of these plant lifespan extensions. And so if the plant is going to last for longer than the 12 years of 45Q, then you would tend to expect a big rebound in emissions once those are turned off. So either you basically need to require the CCS stays on, or you need to plan on subsidizing it somehow kind of indefinitely. To kind of look explicitly at the generation piece of this as well, what you can see, this is a chart showing over time total fossil generation on the y-axis, and basically suggesting that during the period when 45Q is active, so sort of a build time away from now, so we assume plants are built within 3 or 4 years, so kind of 2022, which is when 45Q was announced under IRA, plus 3 or 4 years, all the way up to that end deadline 2032, plus that 3 or 4 years, plus then 12 years of operations. During that time when 45Q is accessible by plants, you tend to see higher fossil generation because that capacity factor potentially jumps. In situations where you do have much higher fossil generation, you are also typically running pretty inflexible units, because once you put CCS onto a plant, you've essentially converted its characteristics to that of a large steam generator with a couple of multiple overlapping reasons why they're hard to turn on and off. So you lose some of the flexibility associated with gas. Not a lot of gas turbines are necessarily installing this, but a lot of the combined cycles and straight steam turbines are. So you lose some flexibility there, but you also end up with this large bump in generation from the fossil sector that is hard to turn on and off, and that you have a big incentive, if you're an operator, not to turn on and off, because the more you operate, the more subsidy you get. The reason that I bring this up is partially to point out that there is some chance that, in addition to just the expenditures, the additional CO2 emissions and that sort of thing, a policy that encourages a higher capacity factor from fossil generators is probably displacing potential renewables. That might be delaying how quickly we actually need to build renewables, which would be the good way to see this coming out. But it's also something that's probably knocking off the ability for some of those units to run, particularly because in the US, we issue subsidies to renewables also based on production, but on production of electricity rather than on production of CO2. Those start to become less financially competitive, just kind of fundamentally, not only because the subsidy is quite a bit lower per kilowatt hour, but because you have these big inflexible units operating at a time that doesn't allow the other ones to operate, and therefore doesn't allow them to generate the thing that's going to get them a tax credit. So this is kind of a secondary dynamic that we don't investigate super closely, but the point that having a lot of inflexible CCS units at this kind of critical build out time for the renewable sector in a way that's likely to bump off some of the profitable hours for those units is also sort of relevant. So you're basically really expanding your baseload situation if you do this to a large extent. And then essentially it's kind of the big major conclusions is that across our scenarios, what we see is that extending lifespan extensions and only covering operational expenditures for short-term periods can actually incentivize cumulatively higher CO2 emissions. So basically, you are running longer, running more while you're running, even though that's abated, but then running unabated once the tax credit period ends. I think I said this, but just to reiterate, we do assume that the capacity factor goes down to baseline once the CCS unit is turned off. So this is assuming that you're not staying at those high levels. But basically, under those scenarios, we generally see either very high abatement costs. So in the two scenarios, 1A and 2A, that you don't see any lifespan extension, you are at minimum $85 a ton of abatement. And then on the ones where you do see some capacity factor increases, closer to 250, because you're also generating more and CCS is not complete. You still do have some emissions with a CCS unit. If you have any lifespan extension, and this, we didn't test it at a full continuous range, but I think this conclusion holds down to about a 5-year lifespan extension. You end up seeing actually that you are paying to increase emissions, largely because of that thing at the end where you turn off the CCS unit. The situation where you have no lifespan extension, no capacity factor increase, which is scenario 2A, is, as you might expect, about an $85 per ton abatement level, because any of the CO2 capture you get is an abatement in the way that this is set up. So it's just equal to the cost of the subsidy. But the total abatement that you get relative to business as usual is only about 24%. What's interesting as well is that in either of the scenarios where you basically just say deadline, so either close all the coal by 2030 or close all the fossil by 2035, you get an abatement level of about 17% for free. So it's an interesting situation where you probably are going to end up paying out quite a lot of money to not accomplish very much. So even in the scenario where there's no lifespan extension, no capacity factor increases, you still end up with 45Q payments of about $440 billion, in addition to all the capital expenditures that accrue to individual ratepayers. And you don't get that much abatement. So it's an interesting and kind of challenging situation to look at. Just talk very quickly about some of the kind of high resolution conclusions of this and then open it up for questions. But I think one point that's sort of interesting when we think about incentives and who wants these policies and all that sort of stuff is that at an individual power plant level, 45Q could be worth above $10 billion for many individual power plants with pretty low abatement. So this is scenario 1A, the one that assumes no lifespan extension. So there's no risk of basically having the CO2 increase afterwards because you turned off the CO2 capture unit, but that you do increase your capacity factor a bit. What we see is that the plant that has the largest potential 45Q payments here would probably be seeing about $18 billion in payments over 12 years, also expending about $7 billion on capital, which is an interesting thing that, again, kind of accrues back to their rate base. All of that to reduce emissions by about 40% at a cost of $210 a ton. That's one example. You can kind of see the other ones. We do this for all of the power plants in our model, actually, but it's kind of an interesting point, I think, to show that there is a pretty significant incentive here. It's not just the 45Q payments, it's also that CapEx with rate recovery, all that sort of stuff. I will also say, and I didn't bring this backup point, but many of the plants that would be experiencing quite significant payments through this program are in places with relatively impoverished ratepayers. So places that generally don't have great consumer advocates, that sort of thing. And so there is a bit of a, not a bit, there's a pretty significant equity issue here as well, because the people that are paying for the capital are, at this point, probably the people that are in the utilities service area. And then the sort of general population is paying these 45Q payments through tax credits, but it's pretty significant for a lot of plants. You can do the same thing for individual utilities because this was an ownership aware thing, but we see a few. So NRG, Texas Power and Light would probably seeing over $22 billion of 45Q payments for, again, not great abatement. I think in no case did we really see lifetime CO2 equivalent abatement versus business as usual of above 60%, even in a situation where we didn't assume a lifespan extension, and cost per ton sort of in the several $100s for all of these. And yeah, again, the CapEx is also pretty high, probably accrues to the rate base, and you tend to see some fairly regionalized patterns of this. So we also kind of go into this at the state level. So all of that to say, this is a policy that exists. This is law. This is something that people are reacting to already, and it's not really in a situation where there are a lot of guardrails. All that said, there are ways to solve these problems, and particularly in situations like potentially in Canada, where you're thinking about setting up a similar thing, or in the US, where we have a couple of opportunities to maybe look to constrain this a little bit. There are some regulatory controls that could help prevent these very bad case scenarios. So one, in the US, EPA has proposed, or Environmental Protection Agency has proposed rules under the Clean Air Act that would basically say we are going to restrict emissions from power plants. This is not law yet, but they do propose to essentially require some level of abatement. That would prevent covered facilities from turning CCS off after the tax credits expire. So that would be a pretty significant loophole change. It doesn't necessarily mean that the cost per ton abated goes down, but it does protect against kind of the worst case scenario where you have a lot of additional unabated fossil operations past the end of the tax credit expiration. The issue with this one, and we submitted some comments on this summer, is that the proposed rule that the EPA has put forward bases compliance on capture, not storage. So hypothetically, you could be in compliance with this rule by just doing the capture and then venting the CO2 afterwards, or more probably by selling the CO2 off to something else that maybe results in re-release. So this is a slightly different issue than 45Q, but it doesn't, even if this policy goes forward completely, it doesn't fully solve the problem. It also doesn't cover that many facilities in practice. State and local regulators probably do have a really significant opportunity here to watch for some of the more project management types of issues. So these projects in the model are assumed to all succeed. historically, what we've seen with CCS projects is that they don't all succeed, and we tend to see very high capital expenditures for projects that are maybe not going to deliver on what they promise to do, whether that's having a CCS unit in the first place or actually reducing emissions, which tends to be the pitch to PUCs and things like that. This is an opportunity where more local regulators that are actually approving permits and approving projects can probably ask some pretty detailed questions that could be somewhat helpful in preventing the very bad case scenarios under 45Q. There are some opportunity costs and there's some cross-institutional incentives that aren't that obvious here. So the biggest one being that the power sector is comprised of a lot of different ownership structures in the US. So utilities own different assets than non-utilities, that type of thing. And so when we look at kind of system level optimizations rather than individual decision level optimizations, you can end up in very, very different places. And then finally, one of the things that we still do see is that even with very successful CCS on gas, you are probably going to be increasing your upstream methane burdens by quite a bit. And that's not something that's accounted for in any of these rules and probably could be relatively easily addressed in a regulatory setting. So with that, I'll just say that you really kind of do need to pay very careful attention to what would have happened otherwise, the counterfactual situation, and really clearly evaluate incentive structures under tax credits like this. But 45Q is a bit of a cautionary tale, and we'll see what happens with it. But there's some fairly significant problems, and I hope that this was helpful and interesting, and look forward to your questions.
Wonderful. Thank you so much, Emily. Please put your questions in the Q&A box. I see some coming in, so we'll start there. I'll actually start with one that ended up in the chat. And that is, how would the introduction of a carbon price in the US change this analysis? Obviously, that's something that we have in place, at least for the moment now in Canada.
Yeah, it's interesting because people have talked about 45Q as kind of a shadow carbon price for a while. It's the closest thing we have to one because it basically says if you sequester, then you get paid for it. So for fossil generators, this basically is a carbon price. The issue is it's a voluntary carbon price. And so you can debate about whether it should be a bigger or smaller number or whatever, but it's a carbon price that does not actually compel action. So I'm not sure that just the existence of a carbon tax would necessarily change this a lot from kind of an individual actor perspective, but there's many counterfactuals to go into on that one too, but it is sort of a shadow carbon price in a lot of ways.
Great, thanks. Another question asking about mid-transition. So does the analysis account for any mid-transition effects where the fossil energy system ramps down, or is it based on present day plant operation and capacity factors? And if it is present day, how would you expect mid-transition considerations to change the analysis?
Yeah, thanks for that question. I think in this particular case, we were really trying to put ourselves in the shoes of a power plant operator responding to incentives that are out there. And so we assume that absent further nudges, they will tend to keep operating as they have been. So we start from a present day situation and essentially then say, with 45Q, there's a big incentive to operate more. For that reason, we don't really look at situations where you start to see a lot of decline because that decline isn't compelled. But yeah, in a situation where you actually had, in the mid-transition context, an actual normative transition to an endpoint that was compelling some of the stuff, you would probably see a very different view. And that's kind of what we were trying to get at by introducing retirement deadlines as a model variable. Didn't talk about that a ton here, but if you play with the model, you'll see you can actually just state dates that plants have to have turned off by, and that does change the situation quite a lot. But in general, I think based on what I've seen, I would not expect individual plants necessarily to start operating less and less and less over time. It's probably some plants will close, others will keep operating and kind of redistribute that power generation even in a more compelled transition situation. But yeah, in this case, we're really looking at the incentives that plants are actually facing as kind of a cautionary tale in some ways to the assumption that the mid-transition is going to happen on its own.
That's really interesting. I mean, just to sort of use moderator prerogative and make an observation here. I mean, I think some of the things that you talked about as potential solutions, and in particular, this idea of end dates, that is actually something that we have, I would say more so across Canada when it comes to at least, sometimes there is a caveat of, unabated fossil generation, but there is a little bit more maybe already of that groundwork in place, which sometimes I think is questioned from a market perspective, and what is the reason to have these hard deadlines as long as you're going to have pricing. But it seems to me that, your work sort of suggests that there is a role for some of these hard deadlines.
I think so. And like just from a US perspective too, Illinois as a state has actually started to put retirement deadlines in place for its coal plants, not for the rest of its fossil fleet, but there is some evidence that people here are also kind of figuring out that if this is a totally voluntary thing, it's not necessarily going to happen the way that you would predict it would. But yeah, I think you're right that Canada has a slightly more facultative framework already in place for having some of these things happen. But just like the US approach to a lot of these things is completely voluntary.
Interesting. Another question about how would or does the EPA 111 emission standards impact the model, and are the capacity factors and any specific details that are key for policymakers to note?
Yeah, also a great question. I spent a lot of the summer needling over the EPA 111 rules. We'll see what happens, right? I mean, like we see what they've proposed. It's very likely that they're going to change before they're actually implemented. So I do always like to kind of flag to the 111 rules could fix some of these problems, but they're not law, and 45Q is. People are already making investment decisions based on 45Q, so we can't actually assume that 111 is going to fix this. But when you look at the proposed rule, I'm cynical probably, but my assumption is that any final rule that's actually implemented will probably be weaker rather than stronger than the proposed rule. Like, we'll see. We definitely submitted comments that were asking them to strengthen it, but the 111 rules are flawed in a couple of pretty significant ways. Like, I'm an academic, I get to talk about them being flawed, but I think that there are a few things that are actually not just like compromises to live with, but actually really serious problems. One being that with the gas sector in particular, almost everything that the EPA 111 rules are putting up basically can be avoided by resource shuffling. So a lot of the time it's CCS requirements for plants over a specific capacity factor that are operating past a specific date and are over a specific size. What we see is that within the system at even kind of the sub-regional levels, this is not just national, we do account for like the need to make sure that there's enough power in individual parts of the system. We don't get all the way down to like line loadings, but basically, if you have a situation where you're above 50% capacity factor on a gas plant, you have to install CCS. You're below, you don't. There's a lot of plants that are operating at 45% capacity factor or 55% capacity factor. They could just both operate at like 49.5, have the same amount of total output and not have to do anything. So that's a really big one, is just that the actual requirement for CCS through that rule is probably pretty low. And actually the requirement for abatement in general is probably pretty low in the gas sector. The coal side, the rules are a lot more oriented around closure deadlines. Essentially, it basically says either close or do increasingly challenging things. So probably more effective on that side. And they are clearly trying to kind of nudge towards closures or very low capacity factors. That would be pretty helpful, in part because it means that you can't do the thing that we're worried about with this model, where you basically run a bunch of CCS and then turn it off at the end of the tax credit period. So that's good. The plant would either have to retire or keep operating the CCS. The big problem that I kind of alluded to is that EPA also doesn't track total abatement. There's no life cycle emissions consideration here. And they decide whether you've complied purely based on whether you've captured the CO2, and what happens to the CO2 beyond that is not tracked. So you could do something where you basically sell it to a indoor farming company and just run the CO2 over the plants or something like that, and it's immediately re-released and it's a totally additional activity. You could sell it into food context wherever, where again, you get re-release. Hypothetically, you could also sell it into utilization context. Probably the one that anyone would actually pay you for is like synfuels manufacturing, which maybe displaces some fossil emissions, but is also really energy intensive and results again in re-release. So the way that it's written means that after the 12 years where you're getting specifically incentivized to store the CO2 permanently, you probably have a pretty strong incentive, now that you don't have any subsidy, but you're required to keep the capture unit on, to find someone who's going to pay you for the CO2. Someone who's going to pay you for the CO2 is probably either some sort of public money, so extending the subsidy, or someone who's going to use it to do something that probably is going to result in re-release. So 111 is a good start, hopefully, but I'm not that convinced that it would solve this problem. It does shut off a couple of the bigger problems that we see. So you're probably not going to get to the $4 trillion for increased emissions issue, but that probably isn't going to happen anyway, just because a lot of these projects are pretty hard to get going. So I have very mixed feelings about 111. I'm glad that they proposed something. I wish that they had been a lot more oriented around actual abatement.
Yeah, I mean, that storage loophole is a really interesting one and, and seemingly
Very
worrying. There was actually a follow-up on that, that the 300 megawatt requirement per unit also would exclude a lot of natural gas EGUs, and it seems like a lot of units could avoid the issue anyway. I don't know if you have...
Absolutely. So the coverage is very low in the first place, and the stuff that is covered can basically comply via resource shuffling. So essentially, the rule doesn't do anything for gas. That's a little harsh. Like, it does something, but not much.
Okay. I have a question, sort of two parts. Maybe I'll start with the more specific one, which is, when it comes to public support for technologies, I'm sort of used to thinking about that in terms of you want to spend more upfront and then have that support sort of taper off over time. But it seems that with CCS, you have this challenge of the difference between the initial construction versus running. And so maybe you can comment a little bit about how that might need to change our thinking of public support for technologies.
Yeah, no, I think it's a really important point, especially in kind of the decarbonization energy transition space, because we have become accustomed, and this is again a very US centric perspective, but I think that this is visible in a lot of countries' policies. We've become very accustomed to seeing clean energy technologies as basically being very high capex, very low opex. And that's kind of the wind situation, it's the solar situation, all these things that don't have fuel. And then even nukes, like there's obviously some O&M, there's a lot of O&M, but you usually don't have really big fuel costs. And so a lot of the policies that have been put forth for carbon management, including power sector CCS, industrial sector mitigative CCS, and then we're starting to see also for the carbon dioxide removal side, so direct air capture, those types of things, tend to be oriented around these sort of successful pathways that we've seen in the past that, like you're saying, really encourage that focus on capital to try to bring those costs down and then let them run. I think there's two really big problems with that in the carbon management sphere, one of which is the really high OPEX, and it's just kind of a fundamentally different thing. And second is with something like a wind or a solar plant, once you have that CapEx covered, you're actually making money by operating. With carbon management, you are losing money by operating. And so it's a waste management strategy. It's not something that's creating a commodity that people are using. You are cleaning up a pollutant. And we're trying to treat it as though there's some sort of commodification approach here. This is part of the marketization of carbon credits and things like that that I also think are really problematic. But we're trying to use paradigms that are really well suited to selling electricity for CO2, and that's not, I think, a super good way to go about this. There's some echoes of the same types of issues with hydrogen, but they're at least like the product that you're actually subsidizing, the hydrogen, is something that people want to buy. So there's hypothetically a revenue stream on the other end of that. In this case, like without some sort of massive regulatory apparatus, there's never a revenue stream for CO2 really, unless it's one of these things that you're going to use to re-release it anyway.
Yeah, thanks for that. We have just a couple of minutes left, so maybe I'll end with one last question, which is sort of more open-ended. You talked a little bit about kind of regulatory fixes that might help address the problems that you identified. If you kind of were, you had a magic wand and you were more at the beginning and saying, okay, given what we know about CCS and those challenges you just mentioned around the, significant OPEX costs, what kinds of policies would you, suggest that we consider for incentivizing or encouraging development instead?
Yeah, like, and to be honest and like to be really explicit, I actually don't think fossil power CCS is a great strategy in the US, mostly because our assets are so old. That's different in different countries. I think Europe kind of has the same problem. Parts of Canada have the same problem, but there are other places where you don't really have the issue of trying to put $1 billion investment on a 50-year-old plant quite the same way that we do down here. But I think in general, from like an overall policy perspective, my answer is always, I think you need to require decarbonization, and everything else follows from that. But just because of the scale of the transition that we're talking about and the coordination that you need at a lot of these processes, I don't think you can do this via voluntary action. And so a fundamental thing that starts out from the assumption that you have to actually decarbonize then lets you kind of sort technologies by which ones are able to help you deliver on that goal in a way that is not quite what we're seeing, where you're basically supporting technologies hoping that they're going to lead to decarbonization, as opposed to requiring decarbonization and then finding which technologies are going to get you there. So that's like a very high level answer, I guess, in a lot of ways. But I think like truly, I don't know that you can solve this without an overall requirement to actually remove CO2 emissions from the system.
Wonderful. Well, that's a great place, I think, for us to end. Thank you so much for joining us and sharing this work. And thanks to everybody who tuned in to listen. As I mentioned, if you want to be notified about future events across the electricity learning series, as well as other NZERI events, you can go to nzeri.ca. That's NZERI stands for Net Zero Electricity Research Initiative, to find out more. And we hope to see you at future events as well. Thank you very much.